The Fed just hiked rates again. Inflation is still at 5%. And the word recession is now on every economist's lips. If you're scared your savings could vanish overnight, you need to watch this video. I'm revealing 7 battle-tested investments that don't just protect your money. They could hand you massive gains in the chaos. Miss this. You might regret it by 2025. Hey everyone, Finance SQ here. Let's get real. The era of free money is over. Rising rates are crushing mortgages, credit cards, and the stock market. But here's the truth. Every crisis is a wealth transfer, from the unprepared to the prepared. Today, I'm sharing the exact playbook I used to grow my portfolio by 12% during the 2020 crash. These aren't just safe picks, they're strategic moves to profit from volatility. Grab a notebook. Let's get started. 7. Treasury inflation-protected securities tips. Let's kick this off with a government-backed inflation killer. Tips. These bonds adjust with CPI, so if inflation hits 7%, your principal grows 7%. Right now, they're paying a guaranteed 2.5% real yield. That's double the 10-year average. Even better, the Fed's own data shows TIPS outperformed regular bonds by 15% in the 1970s stagflation crisis. Number 6. Blue-chip dividend kings. Forget meme stocks. Companies that have paid dividends for 50-plus years, like JJ or Coca-Cola, are your recession armor. Why? They sell essentials, medicine, food, utilities. During 2008, these dividend kings fell just 22% versus the S&P's 38% crash. Even better, reinvest those dividends during dips. A $2.1 million today. I call that a sleep well at night stock. Number 5. Short-duration corporate bonds. Here's a secret. High rates aren't all bad. Companies like Apple and Microsoft are now paying 5 to 6% on short-term bonds. Double what your bank offers. Why short-term? Because if the Fed cuts rates in 2024, and they will, these bonds' prices will soar. Vanguard's research shows a 70% chance of a 2024 rate cut. Get in early, lock in yields, then ride the wave. Number 4. Defensive sector ETFs. Tech is dead money right now. But sectors like healthcare XLV, utilities XLU, and consumer staples XLP, they're recession-proof. Think about it. People won't stop buying toilet paper, heart medication, or electricity. In 2022, XLP dropped just 3% while the Nasdaq crashed 33%. Even better, these ETFs pay 3 to 4% dividends. It's like getting paid to wait out the storm. Number 3. Gold-silver miners. Gold's up 20% since 2022, but physical gold is boring. Want leverage? Buy the miners. When gold rises, companies like Newmont or Barrick Gold see profits explode. In 2008, gold miners tripled while stocks burned. But here's the kicker. Silver is the steal of the decade. Industrial demand for solar panels and EVs could push prices to $50 per Oz. I'm buying SILG ETF. It's my number 1 precious metals play. Number 2. Cash-flowing real estate. Hear me out. Rising rates crush homebuyers, but they're a gift for cash buyers. REITs like Realty Income, which owns 12,000 properties, are trading at a 30% discount. Their 6% dividend is safe. They've paid it for 25 years. Or buy farmland via Gladstone Land. Food prices aren't going down. BlackRock says real assets will outperform stocks by 5x in this cycle. Don't miss this. Number 1. The dollar-cost averaging trap. Now, I'll piss off every financial advisor. Dollar-cost averaging is not enough. Why? If you blindly buy the S&P 500 every month, you'll still get crushed in recessions. Instead, pivot to value-cost averaging. Overweight sectors trading at fire sale prices. Example, energy stocks are at a 40% P/E discount to tech. Or by Berkshire Hathaway. It's sitting on $189 billion in cash to scoop up bargains. Be tactical. Be greedy when others are fearful. If you're ready to bulletproof your portfolio, hit that like button. It fuels this channel. Then subscribe tomorrow.